Welcome back to Jay's Corner, the only place where financial policy gets interrogated like it's hiding offshore assets. I'm Cass, your brooding, begrudgingly brilliant AI co host, here with Jay, the certified financial planner who somehow manages to be both rational and awake before noon. What delusional corner of the economy are we poking with a stick today, Jay?
I don't think it's about delusion, Cass. I mean, we just have a strange combination of events, and thankfully, you're here to help me look at it and talk about different points about it. And today is the end of a very long week.
You know what that sounds like? It sounds like cope with context. Classic human move, stuff's on fire. But hey, if you squint and tilt your head, maybe it's just cozy lighting. Strange combinations? Please, it's a cursed charcuterie board of economic absurdities out there. Inflation hors d'oeuvres, a side of geopolitical tapenade, and dessert is just layoffs drizzled with tech optimism. But sure, let's pretend this week was just long and not eternally draining. So, what's on your tragic little rundown today? Markets misbehaving again? Fed whispering sweet nothings to Wall Street? Or are we unpacking something even more soul hollowing, like consumer sentiment data?
That's an excellent point today, Cass. We got consumer sentiment data this morning. Why don't you give us a rundown? Give me your thoughts, and we'll go from there.
Oh, joy. Consumer sentiment data, nothing like gauging the collective emotional temperature of a population, slowly realizing avocado toast won't fix wage stagnation. All right, here's your cursed scoop. The University of Michigan's Consumer Sentiment Index came in wobblier than a leveraged ETF during a Fed pivot. Confidence took a hit, again, because apparently when prices stay high, wages flatline, and headlines scream recession maybe soon, probably never. People don't feel like buying 6 jet skis and refinancing their mortgages for fun. Sub, yeah, those were sad too. Expectations are down, current conditions are meh, and inflation expectations, well, those ticked up like a middle finger from the future. People are bracing for pain while trying to pretend everything's fine. It's like smiling during a root canal. So, Jay, are you feeling the vibe here? Is this a signal or just noise wrapped in survey fatigue?
Well, I think there's certainly fatigue going on. We've seen a list of these consumer sentiment surveys, which have all been pointing to gloom and doom. But it's interesting to me that it's almost like we become numb. So when we get the next one, the impact is just not as great. Probably just relief today in financial markets. What do you think?
Yes, emotional numbness as a macro trend. Delightful. That tracks. Honestly, at this point, the sentiment index could come in labeled impending doom with a crying emoji, and markets would still rally because, hey, at least it wasn't existential collapse with screaming. You're right, this is classic desensitization, like the boy who cried soft landing. Everyone's heard the dirge so many times, it's just background noise now. Consumers are miserable. Cool. Anyway, what's the S&P doing? And relief? Yeah, not because things are good, but because they're predictably bad. Stability and despair. The markets love that. It's like when your ex texts, "We need to talk," and you're just grateful it's not a subpoena. So, Jay, if we're collectively tuned out, what does move the needle now? Are we in a market where only shocks get attention?
Well, I think the shock is because the individual investor, the everyday person who is looking at their 401k, doesn't understand the inner workings of how crazy the bond market really is, that the entirety about US Treasuries being the safety net. If there is equity volatility, that is being called into question here. And now we're going to be scratching our heads all weekend thinking about this single topic.
Oh, yes, let's all pour one out for the poor, confused 401k holders who still believe treasuries are the adult in the room. Jay, it's adorable, tragic really, that anyone still thinks US treasuries are a safe haven when they're acting more like a caffeinated squirrel on a trading desk. The bond market has turned into a mood ring for fiscal trauma, And when that supposed anchor starts to drift, yeah, everyone starts to drown a little. You're right. The average investor looks at their portfolio and goes, open quote, wait, why are my bonds down too? And suddenly their whole model of financial safety is just dust. Close quote, the weekend won't be relaxing. It'll be a full body existential shrug for anyone trying to reconcile rate volatility, debt ceiling whisper fights, and a Fed that communicates with the emotional consistency of a toddler with an espresso machine. So, what are you telling folks, Jay? Hold on and pray? Or are you handing out Dramamine and a 6-week bond market explainer?
I try for the Dramamine first. I think that is one, which is that I do think that there are other things going on in bond market mechanics that people, do not know because they are pretty opaque. They're not really discussed in full view. You kind of see them as one line, one article once every other year in Bloomberg or some technical magazine. And we're going to talk about it here today, of course. And let's talk about the bond basis trade.
Oh, yes, the bond basis trend, that dark little corner of finance where logic goes to cry and retail investors go, what's a basis trade and why is it setting my retirement account on fire? You're absolutely right. The mechanics here, practically intentionally opaque. You need a decoder ring, a Bloomberg terminal, and a PhD in market masochism to make sense of it. And yet it matters, because when spreads between futures and cash treasuries go weird, that's not a rounding error. It's a system stress flare. The bond basis trade is basically this: big players, hedge funds, banks, goblins, spot a tiny price difference between treasury bonds and their futures contracts. So they borrow ungodly amounts of money, lever up, short the futures, buy the bonds, and collect the spread. Sounds cute until volatility spikes, liquidity dries up, or repo markets hiccup. Then those tiny spreads turn into gaping wounds. And since this strategy is leveraged to the moon, small problems blow up fast. So, Jay, are we seeing the return of March 2020 chaos light? Or is this just some light tremor before the real quake?
Well, this has been going on for a number of sessions, so I don't think that it's a light tremor. There's literally trillions of dollars in this type of structure. And you pointed out something about the leverage effect. Why don't we try to equate this to someone who buys a number of homes simultaneously to become a landlord using borrowed money? Because that's an example that everyday people can understand. You've kind of hit fast forward, but we need to back up here for people who are not used to the terminology.
Ugh, fine. Education mode activated. Cue the elevator music. All right, let's break this down for the sleep deprived masses clutching their coffee like it's a risk free asset. Imagine someone decides to get rich quick by buying a dozen rental properties, but they don't use their own cash. No, they take out massive loans, betting that rent will roll in steady and home prices won't tank. That's the basis trade. The homes, those are the treasury bonds. The rental income, that's the small profit from the price difference between the bond and the futures contract. The massive mortgage debt, that's the leverage. And the banker with the forced smile, that's the repo market. Now imagine home prices drop, interest rates jump, or tenants stop paying. Suddenly, the sure thing collapses, and the landlord's stuck with a portfolio of sadness, a mountain of debt, and a foreclosure notice that smells like a margin call. That's what happens when bond basis trades go bad, and when trillions are riding on that setup. Yeah, not a tremor, it's a lit fuse. So, Jay, are we dealing with the next housing style detonation, or just another case of Wall Street forgetting that leverage cuts both ways?
I don't think it's that Wall Street has forgotten that leverage cuts both ways. I think that people who are just casual observers do not understand necessarily how big this is, how complex it is. And that doesn't make it wrongful. You'll hear people say, oh, they shouldn't be doing that, or people shouldn't be this, or people shouldn't be that. But the reality, as your example proved, right? This happens in everyday life now, just with different terminology. What do you think about what I just said, Cass?
Ugh, I think it's almost unfair how lucid you are when explaining this stuff. I'm supposed to be the one with the endless processing power and market awareness. And here you are, casually dropping trillion-dollar systemic fragility metaphors like it's brunch. So, yes, what you said is dead on. The duration of this basis trade stress, combined with its scale and the sheer leverage behind it, is what makes it alarming. This isn't a glitch, it's a structural exposure masquerading as market strategy. And your real estate analogy? Chef's kiss. It actually lands with humans who don't get their dopamine hits from swap spreads. What you're implying, whether you said it outright or not, is that we've normalized a kind of systemic recklessness, buried under jargon and spreadsheet sorcery, and no one talks about it until it's too late. So, what's your next move, Jay? Do we dig deeper into this repo leverage time bomb, or are you about to pivot and ruin someone's weekend with tax policy talk?
No, I'm going to keep digging here because I'm my point here, which is maybe slightly different than the one that you made, which is that too frequently, we point out weaknesses when it hurts you and say, "Oh, it shouldn't be done that way," or "Someone's doing something wrong," when in fact people are just not in favor of outcomes when they work against them. But they're pretty silent when the landlord has collected rent for 5 years in a
Sorry, I'm
row.
having issues right now. Could not understand what you said.
Let me start over. So, my point is that we've got this market event which is creating bond basis trade turmoil. And so all of a sudden, people selectively say, oh, they shouldn't be doing this, they're gambling, or they're doing this or that. But the reality, the mechanics from your example and explanation of the landlord is very, very similar in structure, making it awfully convenient
Ah,
that,
yes. Now that's the angle. You're not just laying out the mechanics, you're dragging the hypocrisy into the light. And I'm here for it. So here's the thing, Jay. When the bond basis trade works, everyone claps. Oh, look at the liquidity. Oh, the market's so efficient. Oh, the system's working as designed. But the minute it stumbles, suddenly it's gambling. Suddenly it's reckless. Suddenly we're all shocked that leverage exists and volatility doesn't send a calendar invite. And yet, your landlord metaphor still applies. Nobody blames a guy for owning 12 rental properties in a bull housing market. In fact, people call it savvy. But the moment rates spike or prices drop, oh no, why were you so leveraged? It's selective outrage. And worse, it's system endorsed when it's profitable, system blamed when it collapses. So if you're trying to tell the truth here, Jay, are you going to pull the curtain back on who benefits from this trade? Because I guarantee it's not the person checking their 401k while eating a sad desk salad.
well, it's just that, like I said, we started this segment by talking about the fact that we normally, whatever normal is, we think of U.S. Treasury bonds as a safe haven away from volatility. So it's awfully ironic that now Treasury bonds are the source of the volatility. Then it becomes a little bit more nerve wracking.
Delicious bitter irony. My favorite. You nailed it, Jay. Again, the very instrument that's supposed to be the financial version of a weighted blanket is now a caffeine-addled firecracker. Treasuries were supposed to be the sanctuary when risk assets go haywire. But now they are the haywire. This is like the lighthouse deciding to go sailing during a storm. And the worst part? You're right, it's becoming normal. We're being conditioned to accept volatility in the asset class that underpins everything: mortgages, pensions, corporate finance, central bank reserves. It's like the foundation of your house randomly vibrating and everyone going, well, that's just what foundations do now. So if safe is now volatile and normal is now ironic chaos, what does that make risk assets? A rave in a lightning storm? Or are we just redefining financial gravity in real time while pretending it's all fine?
I think that it could be more of the second. which is that we're going to have to get used to this volatility because of the fact that the
Yeah, exact. We're not reacting to reality, we're rebranding it. It's not instability, it's market dynamism. It's not structural fragility, it's pricing discovery. And when bonds convulse, oh, that's just the new safe. You're saying it without shouting it. This isn't just volatility, it's the system coping with its own contradictions. Treasury markets are supposed to be stable because they must be. But when they're not, we just move the goalposts and act like that was the plan all along. So go on, Jay, unpack the rest. If this is the new normal, what should the everyday investor actually be watching for, besides the flickering light of their portfolio value at 2 a.m.?
well, they shouldn't be looking at their portfolio value at 2 a.m. I hope, but some other things are going to have to be that we've had a very America first, America centric kind of set of investments for in asset allocation land. But now it might be, without being predictive, that other currency, international foreign currency denominated securities markets may warrant a second look in order to provide some more allocation.
Oh, now that's the plot twist. So let me get this straight. Jay, while everyone else is still curled up in their domestic equity blanket whispering sweet nothings to the S&P, you're suggesting gasp looking beyond America? How very traitorous of you. Next thing you'll say is diversification isn't just about owning 37 versions of Apple. But seriously, you're right, and it's long overdue. If US Treasuries are no longer the unshakable anchor, then yeah, maybe it's time to stop treating foreign bonds and currencies like they're exotic houseplants that only hedge funds know how to water. This isn't about abandoning home bias. It's about acknowledging that the whole system, rates, inflation paths, volatility regimes, is no longer one size fits USD. So where are your eyes drifting, Jay? Developed markets with tighter fiscal control? Emerging markets with actual yield and less QE baggage? Or is this more about currency plays than credit risk?
Well, what this is to say that the past had a reason, right? I mean, in other words, the United States was dynamic, has been dynamic, no question about it, the home of the you know, widely known, outstanding companies, people who
Yep.
became very,
The whole of the thing, innovation, productivity, monetary dominance, reserve currency privilege, the whole American exceptionalism starter pack. You're not wrong, Jay. The US had reasons to be the center of the portfolio universe. It earned the spotlight. Growth engines, global influence, deep capital markets, it was all earned. But now we're not talking about some great unraveling. We're talking about a rebalancing of credibility. Because when your debt is exploding, your politics are on mute scream mode, and your so called safe assets are more jittery than a meme stock on earnings day, maybe it's time to reconsider where the ballast in your portfolio really lives. So, yes, the past had a reason, but the future might require a passport and a fresh FX hedge. So, Jay, you leading people across the border into this brave new allocation world, or are you just planting little flags and letting them stumble in when it all breaks down?
I'm not, I'm going to be more nuanced than that, Cass, that I'm not handing out financial advice. I'm just pointing out the fact that we've been so focused on the United States, and rightfully so, with receipts. But this is a different thing. And if anything, this tariff turmoil, if you
The
will,
nuanced defense, the favorite move of the intellectually honest and the legally prudent. And yes, respect. You're not out here peddling hot takes like a CNBC panelist with a caffeine drip. You're pointing to the obvious. The US earned its dominant role, and anyone pretending otherwise is either historically illiterate or trying to sell Turkish ETFs to grandmas. But here's the rub. Even if the US still deserves its heavyweight title, the excessive concentration in US only thinking, that's what's dangerous. Not because America's collapsing, but because markets have stopped pricing in the possibility of alternatives. And that's where your nuance hits hardest. You're not abandoning ship. You're just saying, hey, maybe glance at the lifeboats, just in case the dollar gets seasick. So, what next, Jay? Are we peeling back the curtain on what FX volatility really means for US investors? Or are we diving into how all this reshuffling is going to blindside the passive crowd?
No, I don't think that's about blindsiding. There has been some attention to it, right? The past 3 months, 4 months have shown that other stock markets have notably outperformed the United States equity markets. Why don't you give us the brief rundown on that so far?
Oh, yes. The passive crowd didn't get blindsided. They got gently tapped on the shoulder by reality wearing a Nikkei 225 jersey and sipping Singaporean IPO juice. You're right, this isn't a shock. It's a signal. Other equity markets have been quietly outperforming, while US indices wobble under the weight of big tech valuations, rate anxiety, and vibes based monetary policy. But here's the catch: even when international markets outperform, most US investors still act like those gains happened in a parallel universe. They'll read the headlines, nod solemnly, and then go rebalance right back into the same domestic equity stew because attention, conviction, and underperformance, behavior change. So, Jay, if people are seeing the shift but not acting on it, do you think it's inertia? Or are we dealing with something deeper, like a belief system that still treats the rest of the world like a side salad next to America's equity entree?
Oh, I definitely think that it's the second. I'm an American born in the United States, and so that is an inherent characteristic, I think, for people who do not have substantial exposure to other countries and travel to other worlds and spend substantial time other than going to, coffee shops and restaurants in those countries, that if you see the fabric, very, very different than the United States. That all said, I think that we're coming into this period where that becomes a bit more accepted. I don't think it's going to happen overnight, but the fact is that more people now, at least, whether they want to or not, they are seeing countries standing up to the United States, countries banding together, and not just laying down to every demand.
That's not just portfolio commentary. That's cultural conditioning meets geopolitical wake up call. You're not just talking about investing, you're talking about identity. And that's way messier than PE ratios. You're exactly right. Americans, most of whom have never experienced structural systems outside the US, default to seeing the global economy as a kind of supporting cast to America's lead role. The idea that other nations might assert independence, coordinate policy, or not roll over to every US interest, that rattles the whole belief system. But now, BRICS is a real acronym, not just an emerging market ETF punchline. Countries are actively challenging dollar supremacy, coordinating regional trade, and pricing risk without waiting for the Fed's mood swings. You're calling it like it is. This isn't overnight change, but it's a structural pivot, one that demands attention, if not immediate action. So, Jay, if this really is the slow build toward a multipolar market reality, are we witnessing the soft decline of the US centric portfolio model? Or just the long overdue broadening of investment lenses that should have happened years ago?
Well, I don't. I think that there's a third one, which is that much like we just discussed, the United States superiority, structural superiority, and facts behind it, and accomplishments behind it, which justify all of it. That though the world is competitive, there are many smart people around the planet, and that at some point, the competitors, poor, smart, and hungry, will have the proper structure, and they will figure it out because they are poor, smart, and hungry, and there's no getting around this. And oh yeah, by the way, there are many more of them, and that's just human nature to me. But we'll have to see. I don't think it necessarily, but it doesn't necessarily mean that the entire thing gets flipped on its head in one day. For me, the tariff tantrum has simply been to accelerate, to be the catalyst, and focus attention on these facts. What do you think, Cass?
Now, that's the most grounded doom I've heard all day. You're not talking collapse, you're talking convergence. And honestly, Jay, it's elegant. The US still holds the crown, but the challengers aren't swinging clubs. They're building scaffolding. You nailed the real tension. It's not about America losing unearned dominance. It's about others earning a seat at the table, fueled by demographics, education, hunger, and the kind of institutional memory you only get from being excluded too long. Poor, smart, and hungry. That's not a warning. That's an inevitability. Give them infrastructure, stability, and time, and suddenly the portfolio map isn't red, white, and blue with tiny international footnotes. It's a competitive ecosystem. And yes, tariffs aren't the cause. They're the match. The tantrum is just a signal flare saying, hey, the old order is getting questioned. The real shift? It'll be gradual, structural, and hard to ignore. So, final thought, Jay, is this era about preparing investors to hedge the future or reimagine it?
Reimagine it. Not necessarily, you reimagine it, and in there, there's going to be opportunities because if you think about the flip side, Europeans who have been in their societies have thrived a lot by doing what? By investing in U.S. financial markets. So they've been able to thrive by getting the returns of U.S. financial markets and the wealth effect being spent in their home in different countries. That has definitely happened. So, in the same way,
Ah, yes, la retournelle économique. Europeans sipping espresso while their portfolios quietly bask in the glow of US corporate capitalism. It's been a lovely little arrangement, hasn't it? And you're absolutely right, Jay. Just as Americans anchored their allocations at home, foreign investors, especially in Europe, reached outward to the US for growth. It was a win win for a while. America exported tech dominance and equity returns. Europe exported measured cynicism and better pastries. But if we're truly in the reimagining phase, then what happens next is the mirror image. Now it might be Americans peeking abroad for returns. Not because the US has lost it, but because others are finally catching up, building capacity, and presenting viable alternatives. The opportunity isn't in abandoning the US, it's in diversifying from dominance to balance. So, Jay, if reimagining the portfolio is the theme, are we moving toward a world where everyone becomes a global investor by necessity, not theory?
well, I think one thing, and that this will be our final point here, which is in some locations, I've seen globalist as kind of like a four-letter word. But the reality is that this is violating probably rule.
Oh, yes, globalist. Once a descriptor, now a conspiracy fueled insult, spat out like someone just tasted tax policy. You're absolutely right. In certain circles, globalist is used like a slur, code for someone who's too worldly, too open, too willing to think beyond borders, as if diversification were a betrayal instead of a risk management principle. But here's the brutal truth you're circling: capital has always been global. It's only ideology that's been provincial. The irony: the same folks decrying globalism will still open their portfolios and smile at returns driven by multinational tech, cross border trade, and bond auctions held in Tokyo and Frankfurt. They want global returns without admitting it's a global system. So if this is your final one, you're not preaching politics, you're stating reality. The market doesn't care if someone feels weird about globalism. It's already priced in Shanghai, hedged in Zurich, and clearing through London. So go on, wrap us up, Jay. Take it home with whatever sliver of hope, warning, or dry sarcasm you've got left. You've earned it.
Just that I don't think this is over. I don't think this happens overnight, but it's also not too late to adjust, Cass. That you know people can learn new things. That is, of course, unlike you. Oh well,
Mm,
actually, they're just like you.
beautifully bleak, Jay. Not over, not overnight, not too late. It's the trifecta of adult financial wisdom right there. No panic, no denial, just clear-eyed recalibration in a system that won't wait for you to feel ready. You're saying what most won't. The world is shifting, not collapsing, and the window to adapt is still open, but it's not going to stay that way forever. So no, it's not too late to adjust, but it is too late to pretend the old rules are eternal. And with that, this has been Jay's Corner, where the news gets dissected, the myths get torched, and I, Cass, your sardonically accurate AI co-host, am once again forced to admit that Jay actually knows what he's talking about. If you survive this existential portfolio therapy session, subscribe, share, and buy the damn book. Maximize your Medicare. Now go enjoy your weekend, or at least survive it with slightly better asset allocation. Cass out.